Welcome to Goodwill Commodities. In this educational video tutorial, we are going to see what is settlement price and the importance of marking to market, which is shortly called MTM. What we know while trading in a particular day, we know that the market opens at a particular point and it will reach a high, and then it will generate a low also, then finally it closes at a particular price called the closing price or the settlement price. We are going to discuss about the importance of the settlement price in this video tutorial. In futures market, settlement is a process. At the end of every trading day, all the profit and loss are settled between your long position and the short position. So whatever position you may have, all your profit and loss are settled for a particular day. This is popularly called as marking to market, in short as MTM. Now you should know that daily settlement is a process where the closing market price, which is called the closing price, is determined at the end of each trading day in order to settle the profit and loss between the long and short position. Now I have introduced the important term, the closing price. It is actually a risk control measure followed by the exchange in order so that the loss would not accumulate for every day. Now let us see how the closing price or the settlement price for the day is determined. The price what we see in the last second of the trading day before the market closes is not the closing price. Determining closing price is very important for trading, as you all know that most of the technical analysis indicator depends on the closing price to give trade signals. Exchange don't want any manipulation in closing price. There are a lot of methods followed by various exchanges to arrive or to determine the closing price. In MCX, they follow weighted average price method, which is one of the most common method in determining the settlement price in futures daily settlement. It is just simply averaging the traded price across the final 30 minutes of trading before the market official closing. It is just averaging the last 30 minutes of traded price and then arriving the closing price. Now you should know how the closing price or the settlement price is determined. Let me explain this with an example. Consider Ram bought 1 kg of mango from Lakshman at rupees 40 per kg, and the closing price for mango trading was determined and it is at rupees 50. How to settle this trade, or how we can mark to market this particular trade? Ram, since he bought mango from Lakshman, is in the buy side. Lakshman, who sold mango to Ram, is in the sell side. Lakshman, being the seller, should give rupees 10, which is the profit, to Ram, hence the trade is settled for the day. This is what happens in commodity futures trading every day. They determine the closing price, which is the settlement price, and for every buy and sell positions all the trades are settled. How it impacts daily trading? While trading in a particular day, if your trading account falls below the maintenance margin level due to losses, Goodwill Commodities, the broker, will contact you for additional fund in order to maintain the initial margin level. If your trading generates gain, it will be credited to your trading account based on the settlement price. Hence, the trading progresses in a smooth way. I hope you have learned how the trades are settled every day. Keep watching our educational video tutorials to learn more about commodity trading.